Okay, guys. Today we'll talk about options in Greeks, right? Greeks. So what I want to talk about today is mainly I'll go over the definitions, obviously, delta, gamma, theta, vega, right? What they are exactly, and because we do a lot of spreads, because we do a lot of strategies in our my stock life, right? Not many people out there in the groups do it, right? Or even professional traders, because in order to understand them, and in order to be able to put that extra time in teaching your members, it requires a lot of work. I mean, you guys have seen, my stock like admins put in a lot of work after hours. We try to teach you as much as we can, one-on-one also. You guys can DM us, right? At least me, I mean, I reply to most of, actually all of your messages every day I try. So today we'll talk about the Greeks. I'll go over, the first one is obviously, so we have delta, then we have gamma, then we have theta, also known as time decay, sometimes we call it, and then Vega, right? I mean, if you're a professional trader, you're trading options, you don't just want to be blindly trading options, buying contracts at $1, $1.20, $1.30, and then not know what they are, okay? I mean, if you understand options in depth and you want to be a good trader, you can understand numbers really well. You can manage your account better. You know when to take exits on your options, right? All these things come in into the play. Now, options, you guys already know the contracts, they trade at certain prices. On the left, I have Apple open, right? And guys, just confirm on my Apple where my mouse is. You guys can see these numbers clear, so I know the resolution is fine. Awesome. Thank you, Gurish. So first thing in options we have, so let's say, for example, so let's use Apple as our main ticker, right? The options are liquid, the spreads are fine, and so we'll use Apple. Now, Apple right now is trading at 137. Now, there are three types of options, which we define them in three different ways. One is in the money option. So anything at 137. So there's 137 strike, anything under it, right? Any smaller number than 137, any strike that's available, that's called in the money option. Then the strike price, which is 137, the stock's at 137 right now. 137 alone is at the money, okay? So we have in the money, then we have at the money, and then we have out of the money, okay? Now, I'm expecting that all of you guys know this. If you don't know, you're new, no problem. A small lesson for you here. So options are either in the money, at the money, or out of the money. In the money, anything below 137. If the stock's trading at 137, Apple, anything below 137. At the money would be the current stock price, 137, or current price of the stock, okay? Out of the money, anything higher than the current price. So whatever the current price is at that time, anything higher strike than that is called out of the money options, okay? So what exactly is delta in options? Now, let's say we choose to buy 137. So Apple's trading at 137. Let's say for this week, right? Options expiring on July 2nd. What exactly is delta? So expiry is July 2, 21, right? And so Apple right now, let's say strike, we'll go with strike 137. Now, currently, Apple is trading for at 137 level, Apple is trading at 70 by 75 cents. Okay, the spreads are a little wide because at the market close, usually they're 1-2 cents apart. But let's so 70 and 75 cents. So the current value of the option. So the option value here is, let's go with 70 cents. We'll calculate so it's easier for me to calculate. It's 70 cents. Now, how do you understand this option? How will it move? If the stock price moves up or down, how does this exactly move? If Apple goes up by $1, so if Apple was to go to 137, how much would this option be worth, right? To understand. So here it is. So we have four things here. Number one is delta. The delta on these options is 51 cents, okay? 51 cents. Now, if Apple moves up $1 the same day, so let's say Apple from 137 ends up going to, let's say it goes to, let's say it goes to 138, right? How much will your option be? So your option you bought for 70 cents. So first you go 70 cents. And this is the delta. Delta is the increase in an option price plus the current price, okay? Delta is an increase in the option price if the stock moves up by $1. If Apple was to move up by 50 cents, obviously 51 cents will not get added. It will be something less, around 25 cents, maybe 24 cents, okay? So 51 cents is the change in the option price on every $1 move up, okay? So here, the price will be 121. Then there's something called gamma. Now, your delta will obviously increase here with this. The gamma here at 137 is 15 cents, 0.15. Now, what does gamma mean? So Apple, the delta was 51 cents. The option went up by 51 cents. Now, if from 138, if Apple goes to 139, what is the next price? First of all, what is the delta here? Delta here equals 0.51 plus gamma. Now the delta has increased by 15 cents, okay? The delta has increased by, gamma has 15 cents. So the new delta is 66 cents here right now. So what's the new price if Apple goes 139 the same day? 129, sorry, 121 plus 0.66, which is $1.87. Are you guys keeping up with these numbers? I'm going very slow. This is very basic math. I hope you guys are understanding. Is this making sense? Just say yes, so I know.
Yes, Ricky.
Perfect. So I'll go over again. So 137 option is trading at 70 cents. If Apple goes up $1 to 138, what is the option value? So we take 70 cents plus the delta for the $1 move, which gives us $1.21. Now, because Apple's trading at 138, the delta will also change for 138. No, sorry, because you're holding the 137 strike. Okay, so you're holding the 137 strike. Apple's trading at 138. Now, Apple goes up another $1. It moves up another $1. How much is your option price going to be now? So 121. Now the new delta is 66 cents. Okay, of the 137 strike, new delta is 66 cents. This is not the 138 strike, guys. Remember, our strike is 137. Okay, this is just the current price that Apple's trading at 138, 139. Okay, I'll put these numbers here so you guys don't get confused. So this delta is 66 cents when Apple is trading at 138 for the 137 strike. It goes up another $1, 121 plus the 66 cents delta at 187. And then whatever gamma we get here, which will be another maybe 15 cents or 18 cents. So let's just probably another 16 cents, for example. I mean, deep in the money call, closer to expiry, delta goes towards $1. So the new delta here would be 66 plus 16. Now, if Apple was to go to 140, now your options are jumping up even higher. 187. So 187 plus 82. All right, 269. All right, now your options are going up by more than 100% on a $1 increase in price. Okay. So delta is the change in your option contract on every $1 move up. Gamma is what is added to the delta on every $1 move up. The highest delta that you can have is 1. Okay, the highest delta you can have is 1. Usually 0.99 or 1. Okay, no more than that. And then there's no more gamma, nothing like that. Once options hit this maximum. Okay, anything below 99 cents, there will be gamma to be added. So is this first lesson clear? What exactly is delta and how does gamma work with delta? Yes, let's move on. Because I want to get to spreads and teach you guys something else. Awesome. And if you don't understand, I'm recording this lesson, no issues. You will be able to rewatch it again. Okay. Now we have something called theta, or time decay. Okay. Now the theta right here is 17 cents. Now let's forget all this. Nothing happened here. Now, let's say Apple tomorrow, Apple does not move. Okay, theta time decay, this is the value that this option will lose if Apple does not move within 24 hours period of time. Okay, now the trading hour is only 7 hours. From that, in a half day, just divide this by half, that's how much money you will lose, time decay, just for the option not moving. Sometimes when we get stuck in a chop, right, you ask yourself, why is my option value going down? Because there's something else here. There's something called time decay. Option is losing value. So for every one trading day, the theta is 17 cents. If Apple does not move tomorrow, let's say, for example, tomorrow morning, Apple opens at one, right now it's 9:30 a.m. Let's pretend like it's 9:30 a.m. Tomorrow morning, Apple does not move. It opens up flat at 137. My option right off the back is 0.17 minus this. This is the value of my option, 53 cents right in the morning. Okay. Now we're doing closer expiry strikes here. So the Greeks are, that's the reason this is such a huge loss. But if you were to go into leaps, then the time decay is usually less. Okay. Because you have more days left. Now your option value is only 53 cents. If it doesn't move for another day, you know, this theta will change, whatever it is, minus 20 cents or whatever it may be, this goes to zero. So the reason options go to zero is when time decay starts kicking in. Okay, this. Does that make sense right now, guys? Yeah? Okay.
Yes.
Guys, if you're asking questions, everything after, because this, I just want to teach you guys this non-stop is very basic so that you guys understand. And then we have something called Vega. Now, this is the reason now Vega, you know, when stocks like AMC, GME, when they popped huge, why were the options so expensive, right? I mean, these three are very basic Greeks that you can understand. Why were the option pricing so expensive when stocks make a huge move up? Now, Vega is something that works with implied volatility, right? Now, there's something here, which is right here. You guys can see this percentage, 13.77. You guys see it? On the 137 strike? Anyone?
Yes, Ricky. Yes.
Now, Vega we have here is 0.0495. Now, if this implied volatility, if this IV was to go up by one, let's say if this was to go up to 15 points or 15%, right? So 15 minus current 13.77. Which equals,
Ricky, that is 0.04.
sorry, 0.04.
The Vega, yeah, the Vega.
Yeah. So it's $23 points change in implied volatility. Now this change in implied volatility 1.23. You simply take 1.23, right? You take 1.23. You times it by. You multiply by Vega. Your option, even though. Yeah, sorry, I see what you're saying. Right. Good eyes, man. Thank you. Now, if the implied volatility goes up, let's say Apple's trading at 137. Listen to this very carefully. And all of a sudden, Apple has a $1 move up. Apple goes to 138, then it dips to 136 in the next 10 minutes. Then it comes back to 137. Now, that unusual shift of $1 or $2 is not normal within a short period of time for Apple. I mean, it happens many times, but it's not normal. It's not something that happens regular. So here, what's happening is the implied volatility is increasing in the stock, meaning that it's starting to make big moves one way or the other. That usually scares the market makers. And then we have Vega here. This is going to increase because this percentage will increase. So let's say, for example, this 13.77 goes up to 15% in 10 minutes. So you take that change. So 15 minus 13.77, right? And you take this, it's 1.23 in change. Then you take the Vega 0.04. This multiplied by the change in implied volatility, which is 1.23, is 6 cents. 6 cents will be added to 0.70. Even though Apple goes up, down, the volatility has increased, that's how much this price will increase by. Is that making sense, guys?
Yes? Hey, Ricky, quick question. Rick, quick question for you.
Okay.
Do the Greeks be affected incrementally throughout the day? Like, does Theta affect between hour 1 and hour 6?
Yes, it does.
And
sometimes, okay, I got your question. Sometimes the stock doesn't. Let's say, for example, Apple at 9:30 is trading at 137, normal movement. At 10:30, it's at 137 again. Just take we have about 7 hours of a trading day, or 7.5, whatever it is. You just take that portion of time, divide it into percentage, and so this will lose value by like 2 cents. Yeah.
Okay.
Yeah. So Theta's at work all day. Okay. So guys, this makes sense. What delta is a change in an option price. Gamma gets added to delta on the next strike. Theta is every trading day. So if Apple was not able to move, it would lose 17 cents the next day. And then Vega, it works with the implied volatility in the rate change. Is that clear? If you did not understand this, for some of you, I understand this might be a little too advanced because you're new into it, no problem. You have lots and lots of time to learn this. You can learn this every day, just watch the markets, and then you can always watch your own tutorials. This lesson will also be recorded and will be posted in our premium chat, and then you can take advantage of it, okay? Now, that's one. Another thing that I'll show you guys here is now this I won't write here, but this was a weekly expiry. On weekly, these are very volatile. Options are very volatile. If Apple does not move, these other options will go to zero very fast. So let's go out in June 2023, just for an example, right? Or maybe like not that far. Let's go in January 2022. So in Jan 2022, let's go with the 140 strike. Now this option is going to cost me $9.15. Bid is 915, is going for 930. What does that exactly mean? Now, because there's so many days left until Jan 2022, there's more than 6 months left until this. There's a lot of premium added to this call. Even though Apple is trading below 140, but this 140 call is very expensive. Why? Because there's so many days that you're buying. You're buying more than 150 trading days, I believe, or a little less maybe. And then the market maker is going to charge you the money because there's a lot of time that Apple can maybe hit 150, 160, 170. Okay, but let's look at these options. The delta here, for every $1 Apple goes up, this will go up by 46 cents or 47 cents. And then gamma will be added. How much is the time decay? Time decay is not much on this. Why? Because there are two earnings in between. Okay, so even if Apple stays stagnant, it stays sideways, you're not going to lose much. You're losing like 2 cents per day. Okay, so if 1 month Apple does not do nothing, you're only going to lose like $1 premium on these options. But yet you still have more than 80-90% standing there. Okay. And if Apple goes up, then the delta increase you can see. And if it goes down, let's say Apple, and the guys, the same thing if the stock goes backwards, okay? If Apple goes towards 136, that's how much you're going to lose then, okay? You lose 51 cents, these options will be worth like 20 cents, okay? So to the downside, it's also the same thing, but just the opposite. So the reason I buy a lot of leaps or I go really far into leaps is because when I make good profits, I like to park my cash there, is safe. And if I believe the stock continues going higher, I'm going to make money no matter what. My recent examples are NVIDIA, Baba, Amazon. I mean, Amazon is a little closer to it because they're very expensive, but Baba, I'm loaded AMD. So all these options I go into leaps, just understanding the options, your cash is safe there. Even if the stock dips, you can always average down on the next run up and break even, or maybe even go in profits. Okay. Now let's look at vertical calls. How vertical calls work with the Greeks. Now let's say Apple, I buy the 137 call, right? Now in vertical calls, you buy one call, you sell one call. Okay. So 137, and let's say I decide to, so for example, let's do 9 July, something different, a different date. So for July 2nd, I end up doing so 137 and then 138. Now I'm doing a call spread here to limit my risk and make some extra money on it. So let's say, for example, if I buy the 137 call, right? So I buy the 137 call at, which is $1.44 or $1.45, I'll say. I buy it for $1.45. And then I sell the 138 call. The 138 is going for 99 by 104. So I'll say around 102, right? Now I sold this call. Okay, if you don't know what vertical calls are, don't worry, just watch this. It will eventually make sense. How much? So let's say I'm doing one vertical call here. First thing, the difference in my strikes is 137, 138, 130. So first thing I want to do is calculate my max profit, which is the difference between these strikes, which is you can just do the bigger strike minus the lower strike. So my max profit is 1. What's my max loss? My max loss is, now if I bought this call for 145, so 145, and I sold this for $1.02, right? And so this spread is going to cost me 43 cents, and my max loss is 43 cents. So my max profit is 1, max loss is 43. Percentage wise, it's basically saying 0.43 to 1, right? So how much is that? 43 to 1 is
Around 130.
130%. So max profit is 1 or 130%, which is not bad. Okay, to get 130% on this alone, this has to go above 350 or something. Okay. And here, if Apple just gets, maybe just stays sideways or goes up, maybe it closes 138 next week, you can still bank 130%. Now, how does this work? Now, let's say Apple moves up 2 points. Okay, let's say Apple goes up all the way to, or let's just say it goes up to $1. How does the spread work? Now, the 137 call. So the 137 call has, we bought it at 145, right? And Apple goes up 1 point, so goes up $1. How much can our spread be without so Apple goes up $1. Now let's see the calculate the price of our spread, because many of you guys get very confused. Oh, Apple's at 138. Why am I not in max profit? If Apple goes up $1 tomorrow, which is a July 1st, but remember this is a July 9th. Sorry guys. There's still premium added in the 138 call which you sold. Remember, if you want to exit the spread before the expiry, remember you're going to sell this and you're going to buy this back. And this is expensive, you still have to buy it back. So let's say from $1.45, how much can somebody tell me what the price of this will be? Let me test you guys. So if Apple goes up $1, there's 137 call, which is 145. How much is the next price?
145 plus 0.70.
145 plus what?
0.70 the delta.
Nope, the delta right here is below 51 cents, not 70.
Oh yeah, sorry, yeah, 51 cents.
Right. So thank you, Gopi. So it equals 145 plus 0.51, $1.96. Okay. Now what's the price of $1.38? If we buy it at $1.02, the delta on this is 43 cents, right? So this equals this plus 0.43, $1.45. Now let's see the difference here. 96 minus. Our spread value is 51 cents. Make sense? Our spread value is 51 cents. Another way of calculating this is just looking at this 51 cents minus 43. So every $1 that Apple moves up, you'll bank 8 cents on the spread. Now the beautiful thing here is, let's say tomorrow, if Apple does not do nothing, if Apple just goes sideways, right? You will still make, this will increase automatically. Why? Because 138 will lose more value than the 137. Okay, making the difference bigger here. So 43 to 51 cents, that's not bad. I mean, great profits on spread. Then tomorrow, if Apple doesn't do anything for 3 days, it's just trading at 138, whatever it may be, your 138 are going to lose more value. These might be trading at, let's say, for example, $1.10, lose 35 cents. This might be trading at $1.75, right? And your spread still holds a value at 65 cents. Okay, when the time decay kicks in. Makes sense? The reason I do a lot of spreads because we have winning chances against the house. In the stock market, you make money if you're playing calls and puts alone. If you're playing calls, the stock has to go up. There is no other way for you to make money. If you're playing puts, the stock has to go down. There is no other way for you to make money. Now, in the spreads and strategies, whether the stock is going up or down, okay, as long as it's above your strikes, from those 3 options, sideways, up or down, you get to choose 2. The reason I do a lot of strategies because my winning percentage, 66% I'm given automatically by the market. I have an edge on the house. So if I was to do 100 strategies, 66% likely I'm going to win 66% no matter what. Okay, that's the reason I'm able to grow my account consistently. A lot of you guys have learned, and you guys are banking on it. Okay.
So Ricky, just a quick question.
Yeah.
For the vertical calls, this is basically we are playing between the ranges, right?
Yes. Not the ranges.
Okay.
Basically, here what I'm doing is I have a abbreviation. So when I buy the 137, I sold 138 to finance my 137. Now, if I think a bigger move is going to come, then I'm going to buy calls alone. Then I will simply just buy calls alone. The downside to this is, let's say tomorrow, if Apple July 9th goes 145, for example, my intrinsic value of 137, right? Intrinsic value of 137 calls alone will be $8. Okay. So from 1.45 to 8, percentage-wise, that's how much? So 145. So percentage-wise, that's 451% on my calls alone. But because I did a spread alone, my max profit was capped at 130. Why? Because my Apple 130, so 137 calls are 8 intrinsic value, 138 intrinsic value is 7. And now I got a, so 800. I sell this for 800. and then I gotta buy this back for 700, and my max profit is only $100 from $43. Makes sense? Here in the vertical call, your max profit is limited. But if you think it's going to make a bigger move, what you can do is you can always go further out of the money spread. You don't have to do in the money spread. What you can do here is you can simply go 139 calls, or you can whatever spread you want. You can make it wider, less. It's up to you. And 140. So let's see what the max profit here is just quickly. So 130. No, sorry. Yeah, 139 is let's say 70 cents, and 140s are going for 47 cents, let's say, for example, which equals 23 cents, I believe. Yeah, 23. Now my max profit here is 23 to 1, right? 23 to 100, which is almost over 100 or 300%, I believe, which is 334% max profit, right? If Apple makes a big move, not bad, right? So if you go further out of the money spreads, the more max profit potential you have. If you stay in the money at the money, the less, but you can still make good money. The only thing here is if the stock decides to chop, if the stock does not do anything, if it's just going sideways, you can make money. You will make money no matter what, right? As long as it stays near or above your strike price. Makes sense? If let's say if Apple closed at 138 this week, 138.50, now your spread would have given you 100%, 130% was it, or what, right? But your 139 calls would have gone to 0. Makes sense?
Ricky, yes. Oh, my end it does. Ricky, just for example's sake, can you do one more time how to figure out max profits? I hate that you're deleting everything. I'm sorry.
That's fine. That's fine. That's fine. Okay, so max profit on vertical calls, buy, sell.
Yeah.
Oscar, give me a strike price that you want to buy on Apple, for example. Apple's trading at 137. Give me a strike price that you want.
All right, I want to buy the 140.
140.
Yes.
Give me a strike that you want to sell for to finance your 140.
It has to be higher, right? It has to be the 142.
Yeah. 142.
Oh, yeah, I'm sorry, it's not on the screen. So we'll go to 141.
Yeah, I'll give you. I'll do it for you, Oscar. There, every strike's on the screen now. What's up? Well, what do you want to sell?
Yeah, let's do 145s. Just for
145. Now, see, right off the back, I will not sell 145. You know why? Because my 140 are going for 47 cents. Why am I gonna finance only 8 cents for 47 cents? I rather sell the calls alone. Yeah. Okay. Why am I going to finance only 15% of my vertical call? When I buy vertical calls, at least 50% or more should be financed. Yeah.
Got it.
So here, I mean, I would do 142, sure. That's the furthest I would go.
Okay.
So 142. To calculate the max profit, you take your second leg with the first, doesn't matter. It's the difference between these two strikes. So here it will be 142 minus 140, which is 2. So your max profit is 2.
Oh, that's it.
That's it. It's the difference between your strikes.
Max
so
profit.
And percentage wise, this is going for so 140 calls are going for 0.47 mid, and 142s are going for 0.21, let's say. So 47 minus 21, which is 0.26. So 0.26 to $2, which is almost 800% or 700% potential. Right? Because your max profit is 2, so not bad, huh? So the further you go out of the money, the more potential you have.
That's actually not bad. Yeah.
Yeah. And let's say if Apple moves up $2, how much will this spread be worth, right? How much would it be worth? So 0.47 has, so 140 has a delta of 27 cents plus another 28 cents, which is 28, 56 plus 6 cents, 7 cents gamma, 57. Yeah, so your spread would actually, you would gain a lot of money. They will almost pretty much double here, right? And guys, I'll give you guys some homework here. So Apple July 9th here. Apple, you guys can DM me in Discord. I will get back to you tonight or tomorrow. So write this down. This is your homework to figure out. I want to ask you guys something. So right here, I'm going to write this down. Challenge yourself. You must do your homework. Apple, July 9, 2021. So today, Apple's trading at 137. Test yourself, see if your calculations are right. Tomorrow, if Apple hits, forget what Apple's going to open at tomorrow. Okay, I don't care what Apple opens at tomorrow. Let's say Apple hits 140 tomorrow. I want you guys to tell me what next week 140 calls will be worth. So Yeah, I'll write this down here. So I'm gonna write this question here. I want you guys, I wanna test you, let's see. What will next week, July 9th, 140 strike calls be worth? Okay, this is my question to you guys. Let's see if somebody can figure this out. So Apple 140 strikes are currently going for 46 cents, 47. So if somebody can come up with the number right now, it doesn't take too long to calculate. It's less than 2 minutes, right? But if Apple goes up by $3, how much will the strikes be worth? I want you guys to think for 30 seconds, and then I'll do it here live and see if you're on the same page as me. Nilesh asked me a question. Until then, I'll answer questions. So you guys work on this, please. Right? I mean, test yourself, see if you understood something. Yes, Nilesh. You can always sell the resistance of your calls as long as there's good premium and they finance your near the money calls, right? The smaller stocks like Apple, right? You can always do spreads for $2, $1, $3. It depends. Stocks like Amazon, Shop, the spreads will be bigger, obviously, right? Because bigger number. Yeah. But yes, if you buy the in the money call usually and sell the out of the money, your chances are high for working. Okay, so let's do this. So let's see if you get the right answer. So let's help with this. So July 9, 140 strike. So how much is it going for? It's going for, so let's do it right here. Matt, can you get the door? Thanks. So July call 140 strike. Option value right now is 0.47. The delta on this is 27 cents. The delta is 27 cents. The gamma on this is
0.06.
Let's just go the round number, 7 cents.
Okay.
Theta is minus 0.8. And Vega, we don't need to calculate because that's only if the implied volatility change. Yeah. So to Apple right now is trading at 137, right? So there was a $3 move. So let's see. At 140. So this stock value will go up by.
I just know the formula. I got the formula, how it works.
It's 221, no, Ricky? 221?
Okay. Let's work on this here.
254? No, I don't know.
That's fine. Let's work on this. So on the $1, so let's start by 1. So Apple moved at $3, right? So the move was $3, yeah?
Yeah.
So let's do this. So first is our option price plus delta. So that's on move number 1. And then we obviously have the second move, which is equals this. Oops, sorry. Hold on. First, we're gonna do the delta here, 34 plus gamma. So this equals 74 plus 34. And the gamma here will also increase by a certain percentage. I'll just make up a number, let's say 15 cents maybe, right? So delta here equals this plus 15, right? And here we have this plus 149, so 157-ish approximately, okay? And then minus theta, so tomorrow morning when it was gonna open up, it was gonna lose 8 cents in value also, so minus. So 1.57 subtract time decay. So around 149 approximately. Now let's see how accurate. So see, not bad. So if you go $3 back at 137, they're around that price. Make sense? Approximately 149, between 140 150, right? Because Vega will also adjust. But approximately 149. Well, I mean, hey, 146, you're right on point. Hamza, you're right on point, man. I mean, 2-3 cents, obviously, this is not accurate because certain Greeks will change with the market sentiment, how fast they went to 140 maybe and whatnot. So you're right on point. Great. Did that make sense, guys?
Yes.
So a very short lesson, but yet so valuable, right? I tried to cover this in as much clarity as I could in very, very simple terms, right? So I hope this made sense to you guys. And also for the spreads, if you guys ever want to calculate how much the spreads will be worth, that's how you can calculate it. And what do I end this with? Let's see. What can I end this with? What can I tell you guys? Okay, I'm gonna give you guys some levels. You guys hear from me every day, but one more time. Baba above 231. If it holds, write this down. Amazon 3560. Write these levels down. These two numbers I'm giving you guys, these are life-changing numbers. Okay, that's all you need to know. These are life-changing numbers. I'm telling you this right now. This Baba holds about 231 is gonna fly. Amazon takes 3560 plus close, it's gonna fly. That's all you need for your life to change your life. Great, guys. I hope you guys learned something. That was a very short and nice lesson. I thought it was going to take longer, but I covered it pretty much pretty fast. Delta, gamma, theta, vega. Okay, know these for your thing. And this will be recorded. We're going to post this very soon. Watch it once, watch it twice, watch it twice as many times as you need to, no problem. And understand these. And then there is something which is rho. If you want to get more deep into it, then there's Vama, there's Lama, there's Ultima. There are a few more Greeks, which I won't get into it now, but I hope this lesson made sense. It was I brought some value to your trading career, and I guess with this I'll end it, and we'll see you guys in the chat. Pre-market, come into the pre-market,
Ricky,
come up with something crazy. Yes, tell me, sir.
I'm sorry, I have a question for you.
Go for it.
Well, sometimes we see option sniper only looks for a gamma for the options.
Mhm.
Can you go over that a little bit, please?
See, option sniper, his trading, so you have to understand he buys a lot, like different positions, right? He looks out for them, and then some of them hit, some of them don't, right? So those are simply assist of, for example, me picking a star. Let's say, for example, LUV right now, right? Love Airlines, and I think by the end of July, as catalyst is that the summer is opening up, and I think it's going to do well. It's trading at 53 cents. I think this is going to make a $7 move, for example, right? Or maybe bigger. They have earnings on 22 July, so I won't put this. Let's go 16th July, for example. And I think this is going to make a big move. I think this goes to $60 by the July 16th. That's going to make a $7 move. So I'll simply go look at the $58 options, which are 18 by 19. Okay, 18 by 19 cents. 18, or let's just say they're trading at 18 cents, and I think it hits $60 by my expiry. And if it does hit 60, right? If it does hit 60, this is a 50th strike. I got intrinsic value of $2 right here, which is how much? Almost 900 plus percent. Okay, 900% plus. If it hits 60, that's how he cashes his plays. He looks for some certain stock which is sold, and he buys out of the money calls at cheaper, and he holds them until a stock keeps going up. And let's say if this goes to $63, which sometimes they go even higher, the intrinsic value of 58 is 5, which gives me a return of almost 2,500% plus. Make sense? Like space that he held on for squeezes, right? Those calls went from like 10 cents to $8. That's 8,000%, right? So many times we get those squeezes like space. I think he had the 20 calls, I believe, at 0.10, and space closed at 28 that week. Intrinsic value is 8, right? That's almost 8,000%. But what are the likelihood chances that you're going to cash this all the time, right? I mean, is that something that you can learn, you can bring into your trading style, then go for it. Otherwise, why be in the market to make these? I mean, he does great. I mean, I wish him all the best. But is this realistic lifelong? Just ask yourself. If it was, then you're about to become a billionaire in the same month, right? I mean, banks only offer 6-7% annually. So why not trade the right way, proper, consistently? I mean, that, and then you can obviously play with these in the combinations when you have enough money in your account. Okay, do the trading the right way. You will sleep peacefully. Your account will grow. You will not have emotional uphills and downhills. Okay, and
Ricky,
yes, sir.
Thanks for that explanation. One of the things that sometimes you guys say is, oh, the options aren't priced correctly. Those are great investment.
So that sometimes what happens is that comes with practical experience in this sense. Let's say, for example, if Amazon stays at 34.50 for the next 2 weeks, implied volatility, it lowers, it goes down. Okay, when implied volatility goes down, option prices fall. Okay, when option prices fall, then we look at it, and because we are watching numbers all day, then we see, hey, you know what? Amazon at 34.50, there are 3 trading days left. Why are the 3,500s only at 1? 3 weeks ago, when Amazon was at 34.50, the 3,500s were $5, right? So that's just something I mean, that's just something, remembering numbers, knowing on your own. And then I can be like, okay, so Amazon's about to move. Those options are only priced at 1. Amazon goes up 100 points. Those options will be $50. They're cheap. So I'll take that risk. Make sense?
Hmm.
Now those things come with practical experience. You gotta keep a track of it, and you just have to remember numbers. You have to be very focused. So that's what it is. So that's how you know that they're mispriced if IV is really low. Right. So that's why sometimes during intraday I just watch numbers. I just look at them. That's how I remember things. Yeah. So yes, guys. On to my next class that I have now. Thank you for being here. This was a very good session. I'll definitely put this up maybe tonight because there's not much to edit in this. And
Thank you so much, Ricky.
No problem.
Love the energy, man. Thank you.
Like
Thank
these
you, bro.
things have really helped me out, to be
Yeah,
honest.
it's all you guys, man. It's not me. It's all you guys that pump me up all the time. Love helping you guys. Pump him up. T says hi.
Ricky.
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 Let's go to the moon.
I'm insultable.
I'm Michelle to the moon, man, for sure.
Yeah, my new Mexican.
Thank you guys so
by the
much.
way.
Ricky Ricardo.
That's it. All right, God bless, guys. I love you guys all. I'll see you guys back in the chat tomorrow.